Accounting CMA Intermediate Book Back MCQ Numerical questions. Accounting for shares and debentures. If total issue size is 2 lakh and the underwriter commits for 100% underwriting at a commission of 4%, what will be the commission payable on shares unsubscribed if number of applications received is 1,40,000? The issue price of shares is rupees 12 for each. Face value of shares rupees 10. The answer is 28,800. Shares unsubscribed 2 lakh minus 1 lakh 40, that is 60,000 shares. Commission on shares unsubscribed is 60,000 into 12 into 4%, that is 28,800. Total commission payable is 2 lakh into 12 into 4%, that is 96,000. Amount payable by underwriter is equal to amount payable on unsubscribed shares minus commission, that is 7,20,000 minus 96,000. The answer is 6,24,000. But here the question is commission on shares unsubscribed. So the option A is right. Paid up share capital rupees 10 lakh and free reserves rupees 2 lakh. What is the maximum amount permissible for buyback of shares? Rupees 2,50,000. Resource test 10 lakh plus 2 lakh, 12 lakh into 25%, rupees 3 lakh. That is 25% of paid up capital plus free reserves. Shares outstanding test rupees 10 lakh into 25%, that is 2,50,000. 25% of outstanding shares. Debt equity ratio test, debt after buyback exceed twice the paid up capital plus free reserves. But here the debt details not given. Least of the two is rupees 2,50,000. So the answer is 2,50,000. Cash flow statement. Net profit for the year rupees 15,000. Interest received in advance on 1st January 2025 rupees 2,000 and 31st December 2025 is rupees 3,000. Cash from operation will be rupees 60,000. Net profit plus increase in current liability. Here interest received in advance is a current liability. So net profit plus increase in current liability. The answer is 16,000. X Limited purchased machinery of rupees 10 lakh, issuing a check of rupees 2,50,000 and 10% of debentures of rupees 7,50,000. In the cash flow statement, the transaction will be shown as outflow under investing activity rupees 2,50,000. Rupees 2,50,000 only paid by check and 7,50,000 only by issue of debentures, which is consideration other than cash. So the cash outflow is only rupees 2,50,000. Given salary expenses rupees 40,000, outstanding in the beginning of the year rupees 5,000 and outstanding at the end of the year is rupees 10,000. Cash outflow on salary will be 35,000. Here salary expenses plus previous year outstanding minus current year outstanding. If the net profits earned during the year is rupees 50,000 and the amount of debtors in the beginning and end of the year is rupees 10,000 and rupees 20,000 respectively, then the cash from operating activity will be 40,000. Debtor is a current asset, so net profit minus increase in current asset. The answer is 40,000. If the net profits earned during the year is rupees 50,000 and the bills receivables have decreased by rupees 10,000 during the year, then the cash flow from operating activity will be equal to 60,000. That is net profit plus decrease in current asset. Accounts of banking, electricity and insurance companies. Date of bill 15th October 2023, period 5 months, rate of discount 8%, amount of bill 50,000. Calculate rebate on bill discounted if accounting year ends on 31st December 2023. Answer is 852.46. Date of maturity 15th October 2023 plus 5 months plus 3 days, that is 18th March 2024 is the due date of the bill. Unexpired period is January 31 days, February 29 days because it is a leap year, and March 18 days. Total unexpired period is 78 days. Rebate is equal to amount of the bill into percentage into unexpired period divided by total number of days in the year. Here, as it is a leap year, the total number of days is taken as 366. So 50,000 into 8% into 78 by 366. If it is a normal year, then we have to take February 28 and the total number of days 365. In that case, the answer is 77 by 365. If an infrastructure loan is identified to be substandard with a secured exposure of rupees 200 lakhs and unsecured portion of rupees 300 lakh, calculate the provision at applicable rate in case of a banking company. The answer is 90 lakhs. Here we have considering the loan as infrastructure loan, because substandard advances secured exposures, the provision percentage is 15%, and in case of unexpected unsecured exposures in respect of infrastructure loan accounts where certain safeguards such as escrow account are available, 20%, unsecured exposures in respect of other loans it is 25%. So the provision is 200 into 15%, 30 lakhs, plus 300 into 20%, 60 lakhs. Accounting standards. The expected sales value of stock is rupees 20 lakhs and the commission at 10% on sale is payable to the agent. Calculate NRV. 18 lakhs. That is sales value minus selling expenses. On 1st April 2025, B Limited has 1,200 ordinary shares outstanding. On 31st August 2025, it issued 400 ordinary shares for cash. On 31st January, it bought back 200 ordinary shares. Calculate weighted average number of shares. The answer is 1,400. That is 1,200 shares for the first 5 months. That is April, May, June, July, August. And next 5 months, it is 1,600. That is 1,200 plus 400. And for the remaining 2 months, it's only 1,400. That is 1,600 minus 200. So the weighted average number of shares is 1,400 shares. Fair value before right issue rupees 20. Theoretical ex-right fair value rupees 18. Calculate right factor. 1.11. That is right factor is equal to fair value per share immediately prior to right issue divided by theoretical ex-right fair value per share. That is 20 divided by 18. Salary payable per day rupees 1,000, working days 300, leave unutilized during the year 3 days. Unutilized leaves are not allowed to carry forward but are settled through payment. What is the expense to be recognized as per Ind AS 19? Rupees 3,03,000. That is salary payable per day is equal to 1,000. Unutilized leave 3 days. Payment for unutilized leaves is 1,000 into 3, that is 3,000. Total salary expenses is equal to 1,000 for 300 days, that is 3 lakh, plus unutilized leave salary 3,000. The total salary expense is 3 lakh and 3,000. Ordinary shares of 1 lakh of rupees 1 each. 10% preference shares are 2 lakh of rupees 1 each. Profit after tax is 10 lakhs. Calculate basic EPS 9 rupees 80 paise. That is profit after tax is 10 lakhs less 20,000. That is preference dividend 1 lakh into 2 lakh into 10%. 20,000. Basic EPS is equal to earnings available to equity shareholders divided by number of equity shares. That is 9,80,000 divided by 1 lakh. The answer is 9 rupees 80 paise.